Hi everybody, Dana Sparks, broker of Maximum One Greater Atlanta Realtors, and today's contract tip has to do with the difference between a financing contingency and an appraisal contingency. This gets to be a little bit of a squishy area at times, and just wanted to go through a little bit to help describe or explain what the difference in those contingencies are in a real estate contract for a buyer to purchase a home. So if a buyer is getting a loan, then they will make that contract typically. They don't always, but typically a buyer will make a contract subject to their ability to get the loan. That is the financing contingency. They will also, if there is a lender involved, typically make the contract subject to the property appraising for the sale price or a higher value. And you will see those two separate, they're related, but they are separate contingencies spelled out in the contract forms. So in the GAR contract form, the appraisal contingency and the financing contingency are all spelled out on the contingency loan exhibits. So in the GAR purchase and sale agreement, the conventional financing contingency form is GAR form F. Why can't I find this easily? GAR form F404, and the FHA is GAR form F407. There's also a VA financing contingency form and a USDA financing contingency form. There is also a cash exhibit, and just to let you know, the cash exhibit also does have the option for it's not a contingency, and it specifically says all cash or non-financing contingency, but it does allow potentially for a buyer to get a loan. They're just not making the contract subject on their approval of that loan. But also in the all cash exhibit, there is a place for an appraisal contingency if the parties negotiate that. But all the loan exhibits in GAR are in the 400s. So in the RE forms, the actual contingency itself is spelled out in the actual purchase and sale agreement, which is RE 100, and that is in the paragraph 6.6 contingencies, and 6.2 is the appraisal contingency, and 6.3 is the financing contingency, and then that is further described or explained, and the consequences are spelled out in the standard terms, which is RE1, in the 6.2 and 6.3 paragraphs that correspond to the purchase and sale. So let's go back a little bit. Let me talk a little bit about, go back to GAR. Well, let me just talk in general about a financing contingency versus an appraisal contingency. So a financing contingency means that the seller grants the buyer a certain amount of time to convince a lender, for the buyer to convince a lender to lend them the money to purchase the house. So in that time frame, the buyer must convince a lender that they are worth the risk. They are worth the risk that if the lender lends them money, they will pay them back over the amount of time given, 30 years, 15 years, so forth and so on. And so a lender will assess all types of things about the actual borrower or buyer. They'll look at their credit history. They'll look at previous amounts of money that were lent to them and how they paid them back. How much money, how much financial obligation do they have out there now? But a financing contingency is a lender's assessment of the financeability or payback ability of the actual person based on their financial history and their current financial status, their income coming in, their bank account, their savings, and again, like I said, what other loans they have out there, what other financial obligations they already have to pay back. An appraisal contingent. Oh, and if be, so when okay, so that's a finance contingency. It's an assessment of the person. An appraisal contingency is an assessment of the property or of the house. So if the lender says, yes, I am going to take this risk and lend the person money to buy this house, I feel like they are going to pay me back per the terms we agree on in the amount of time we agree on. However, I'm going to hedge my bet a little bit. So if something were to happen and the borrower does not pay me back the money that I'm lending them to buy this house, then I'm going to have some collateral. And the collateral is going to be the property. So if the person doesn't pay me back, I'm going to foreclose on the house and I get the house back as an asset. So an appraisal contingency is an assessment of the collateral. Is the house going to be such that if I do have to take it back and sell it, will I cover the amount of money that I lent the person who didn't pay me back? So it's a cover to hedge my bet. It's saying for the lender, is the property in and of itself worth the money that I'm lending, just in case the person doesn't pay me back? But as a lender, the first line of defense is an assessment of the person. But the two go hand in hand when there is a loan involved, because the lender needs to make sure that, number one, the person's going to pay them back, but if they don't, will they recover an asset that they can turn around and resell and still recoup their money? So that's the difference. The financing contingency is an assessment for the financeability of the person. The appraisal contingency is an assessment of the status of the collateral worth the money in case the lender has to get it back to recoup the money that they lent out. So the issue that we come in, and there are two separate contractual contingencies, both in the GAR form and in the RE form. Now, if a buyer and a seller, you're working with a buyer and a seller, and they go binding on any other contract, you will have to read verbatim the terms of that contract to understand these actual contingencies. I will also tell you that if there is a loan involved, generally speaking, for the majority of the loans involved, a lender will require an appraisal. That's not always. It depends on the amount of down payment a buyer's putting down. It will depend on the institution that's lending the money. But generally speaking, if there is a loan involved, an appraisal is required. If there's not a loan involved, or if the person's paying cash or getting a hard money loan, then an appraisal is typically up to the buyer, but it's not necessarily required because there's no lender involved to worry about the collateral should there be a foreclosure. Well, anyway, so in the contracts and the purchase and sale agreements, there's a lot in these loan exhibits, but I just want to focus on these two contingencies. So in the actual financing contingency, the buyer and the seller negotiate X number of days from the binding agreement for the financing contingency period. And what that means is the seller is granting the buyer X number of days, and we're seeing anything from 14 to 21 to 28 to 30. That's going to depend on the lender. That's going to depend on the amount of information the buyer has already, their communication with the lender already, and what they've already given the lender, so forth and so on. But anyway, and the type of loan. So basically, let's just say, for example, 21 days. That means the seller is giving the buyer 21 days to convince a lender to lend them the money. I promise you I'll pay you back. Here's my history. Here's how much I owe, so forth and so on. If a lender doesn't think that the buyer is a good risk for the lending of that money, then the buyer needs to find that out within that time frame. And the buyer may terminate the contract within that time frame. They have to do two things. They have to terminate within that time frame. The seller only gives them so much time to terminate on a financing contingency, and they have to prove it with the loan denial letter. Now, please watch all the other videos I've done on the termination. There are very specific reasons for the loan denial letter in order for the buyer to protect their earnest money upon termination of a financing contingency, so forth and so on. But in essence, that's what a financing contingency is the seller granting the buyer X number of days to convince a lender to lend them money based on that loan. Now, an appraisal contingency means that the lender is going to send out an appraiser to assess the property. So there's a time frame for that. In the conventional loan contingency, again, a buyer and a seller negotiate X number of days from the binding agreement date for the lender to actually send out the appraiser and assess the property. Is the property worth the amount of money that the lender is lending in case as collateral for this loan? And if the property does not appraise for the sale price or higher, then the buyer has X number of days, whatever was negotiated. And again, we're seeing typically 21, 28, 30 days. We're seeing that those kinds of numbers. Now, there's a lot more to the appraisal contingency. It depends on the type of loan. And it depends on the season, how busy are the appraisers, so forth and so on, and how many comps are in the area. But anyway, so that is protection for a buyer, that if the property does not appraise for the sale price that has been contracted, then the buyer and the seller, there's a few differences. In the GAR contract, the buyer must give the seller, in a conventional loan, the buyer must give the seller the opportunity to sell it for the appraised price. So the buyer would have to initiate an amendment to the seller along with a copy of the appraisal to give the seller the option to sell it for that appraised price. If the seller doesn't agree to, then the buyer may still go forward with the deal, and the buyer would have to pay cash for the difference between what the appraised price is and what the contract price is, or the buyer has the right to terminate the contract and get the earnest money back. That's in the GAR. In the RE forms, under a conventional appraisal contingency, if the appraisal price comes in lower than the sale price, the buyer may immediately terminate. In the RE forms, you don't have to give the seller the option to sell for lower. You may, but it's not contractually required. In GAR, it is contractually required. In both of these contract packages, if the buyer is getting an FHA insured loan or a VA insured loan, then the buyer, there's no time frame. In an FHA and VA insured loan, these are government insured loans, and so the government regulations control over our contracts. The buyer has the option to terminate and get their earnest money back, and that time frame goes through day of closing, whatever the last contractual or amended day of closing is. There's no time frame for protection for a buyer's earnest money on a VA or FHA insured loan. And those are all spelled out in the contracts. So it's pretty easy to understand if the sale price, if the price of an appraisal comes back lower than the contracted sale price. The issue we're running into are, what if the appraiser mandates repairs? In other words, the appraisal is coming back and the appraisal is at the sale price of the contract. However, the appraiser says, but these repairs are needed. In essence, what that means is, yes, this house, this property is worth, the collateral is worth this dollar amount, provided that these repairs are taken care of. If these repairs are not taken care of, it's not, the price isn't supported. So there's a lot of confusion about if an appraisal comes back and the appraiser gets to the lender and the lender mandates repairs. Does that fall under an appraisal contingency or a financing contingency? And the answer is that falls under an appraisal contingency, because those repairs have to do with the status of the property that is the collateral for the loan. It's not the financeability of the person. The lender has already determined the person is a good risk. They don't have too much other outstanding debt. They've got good income. They've demonstrated through their credit history that they pay back. I'm not concerned about the person paying back. However, just in case something were to happen, because we can't predict the future, if I were to get the property back, yeah, the price is there if this and this and this are done. So repair issues are an appraisal contingency issue because it has to do with the property. If they're not worked out, no, the buyer's not going to get their loan, but it's not due to the, for lack of a better word, again, financeability of the person. So the confusion comes in because of the verbiage on our exhibits. In the GAR, Conventional Loan Contingency Exhibit, for the appraisal contingency, it's paragraph 11, it states that the contract is subject to the property appraising for the sale price, and the buyer has so many days. But it specifically addresses what the buyer is required to do if the price comes in low. And it specifically talks about the buyer must send the seller an amendment to the sale price. So it doesn't specifically address a repair issue, but as we have discussed, a repair issue, the price is only supported should these repairs be completed. So that's in the GAR Conventional Loan Contingency Exhibit. In the RE forms, under the appraisal contingency, and this is spelled out under the standard terms, it also addresses the property appraising for the sale price. It specifically talks about a sale price. It doesn't specifically mention repairs, but again, these repairs support the price. Now, so the issue comes in with a buyer getting a conventional loan. In the FHA Loan Contingency Exhibit and the VA Loan Contingency Exhibit, both in the GAR contract package as well as the RE forms contract package, the appraisal paragraph is all contained in what is called the amendatory clause. And basically it states that that per FHA or per VA, so forth and so on, the property, again, must appraise for the price. But let's talk about the repairs. In the FHA and the VA loan exhibits, in both GAR and the RE packages, the repairs are already addressed. It says repairs required. I'm reading from the GAR, Georgia Association of Realtors FHA exhibit. It says repairs required in FHA commitment. Paragraph 15 in the GAR FHA exhibit. Any repairs required in the FHA commitment shall be completed and paid for by, and you negotiate buyer or seller prior to closing, provided such repairs do not exceed X amount of dollars in total cost. The issue has come up. What happens if the repairs that are mandated in the appraisal and the lender's going to require, what happens if they're over that amount? So in the GAR loan contingency exhibits, FHA and VA, it specifically states, and it states, in the event the anticipated costs exceed the amount listed above, the seller shall provide the buyer with an itemized written statement of the total cost of repairs required in the FHA commitment. In other words, the seller is required, it's the burdens on the seller to go hire a third-party contractor to get an estimate of the repairs. So the seller's already going to pay X amount of dollars of those repairs. That was already negotiated when the parties went under contract. Then the seller must give this estimate in writing to the buyer. From the date that the seller gives this estimate to the buyer, the parties have 3 days to negotiate through who is going to pay for the additional amount of repairs. And what it says is within 3 days of the date the seller provides the buyer with the written estimate of the above referenced cost of the repairs, the buyer or the seller must negotiate who's going to pay the difference. If the parties fail to agree in writing within this time frame as to how the excess repair costs are to be paid, then the agreement automatically terminates and the buyer will get their earnest money back. If the buyer agrees to pay the excess amount, the same shall be paid to the buyer to the seller at closing, from the buyer to the seller at closing, because the repairs have to be done prior to closing. That verbiage is in the FHA and VA loan contingency exhibits in the Georgia Association of Realtors contracts. It is not in the conventional loan exhibit in the Georgia Association of Realtors, and it's not in it's not addressed at all in the RE forms. Now, the Georgia Association of Realtors created a special stipulation in 2020. It is Special Stipulation 524, and it is basically the same verbiage. And I'll read that to you again in a second. The issue is we are having an increasingly number of conventional lenders that are requiring repairs to the property to support the appraisal price. It's not happening a lot, but we are seeing it. And generally speaking, we are seeing it when the buyer is getting a loan from a bigger bank or a traditional bank. And so this special stipulation, it's the Georgia Association of Realtors Special Stipulation 524. It states, again, it's the same verbiage I just read, any repairs required by the lender are to be completed and paid for by, and you negotiate buyer or seller, prior to closing, provided such repairs do not exceed X amount of dollars in total costs. In the event the anticipated costs exceed the amount listed above, an itemized estimate shall be provided to all parties from third-party contractors selected by the seller of the total cost of repairs to be made to the property. Seller or buyer shall have the option to pay the excess amount. If the parties do not agree in writing who shall pay the excess amount, then this agreement shall terminate within 3 days of written notice of the itemized estimate. So again, FHA and VA loan repair issues are addressed in the exhibits. In the GAR exhibits, it is addressed if those repair costs exceed what was negotiated when the parties went under contract. And as an agent, there are just a couple of other contractual issues to bear in mind regarding an appraisal. What is it that you are putting in the contract about repairs? In other words, when the buyer and seller initially go binding on the original offer, are there any repair issues addressed as a special stipulation in that offer? And if a contract is subject to due diligence, and during that time frame, a buyer and seller end up instead of negotiating for repairs to be done, but write an amendment to change the sale price. In that amendment, do they just change the sale price, or does that amendment reference the phrase in lieu of repairs? So different appraisers are looking at the contracts. Some are reading the entire contract, some are not, some are looking at various parts. It depends, but those contractual issues the lender is definitely looking at those contracts and the verbiage that you have when you are addressing repairs. An appraiser is looking at the property in terms of its functionality, livability, inhabitability, desirability, and longevity of the property itself in relation to other properties in the area and similar price ranges. So just again, a couple of other things to bring to your attention as an agent is how and when and in what manner are you addressing repairs in the contract in and of itself. What happens if you are working with a buyer getting a conventional loan? So here are agent points of practice. Number one, if the buyer is getting a conventional loan, first of all, are they getting the loan from one of the bigger banks or one of the traditional banks? Number two, when you show the property, are there repair items that you think may or may not be needed? Now, again, this is a little bit of an interesting issue because there are a lot of buyers that will get a conventional loan to purchase a property that needs repairs. Either the buyer is going to do a rehab on it or completely renovate it, or they're going to tear it down and build something new. So it is not that frequent. Nevertheless, you want to be able to protect the buyer when this happens because it's not a financing contingency issue, it's an appraisal contingency issue. So if you are working with a buyer getting a conventional loan, again, check out the property. If you think it's going to be repairs, you might want to go ahead and include that GAR Special Stipulation 524 in your purchase sale agreement when you are negotiating and going under contract. Number 2, check out the property when you're showing it and see if this is definitely going to be an issue that's going to be needed. If you are if you're negotiating on the RE forms contract, regardless if it is conventional, FHA, or VA, you probably want to use verbiage similar to this to address repair issues that come up. Again, repairs are already addressed up to a certain amount, but you might want some verbiage to address what happens if the repair costs exceed the amount that is negotiated. The other issue is, so what happens? What happens if this doesn't get negotiated out and the parties terminate? And let's say it is a repair issue, the buyer terminates. They're outside of their financing contingency, but they're terminating still under their appraisal contingency, and the parties don't agree on the disbursement of the earnest money. Well, again, this is a little bit of an interesting issue. It definitely would help if all of that verbiage was spelled out regarding these issues. But in essence, that is one of the prerogatives of the holder of the earnest money, is to make this contractual interpretation. And again, I postulate that repair issues are an appraisal contingency issue because it is something having to do with the collateral. It's not the financeability of the person. The collateral is, see, the disconnect comes in because the appraisal comes in at sale price, but with mandated repairs. And so the question is, but it came in at sale price. But no, it came in at sale price with an asterisk. Sale price if provided that this, and this are done. So again, it depends on the holder of the earnest money and the interpretation of the contract. But again, I ask you to consider that this is an appraisal contingency issue because it does have to do with the property and not the person. And I just ask that as an agent, you consider addressing these issues up front when the buyer and the seller negotiate in the original offer, that you anticipate this issue coming up and already have it agreed upon between the parties how to address this issue should it come up. If you are a Maximum One agent, you are more than welcome to use those special stipulations. Please get with your managing broker, your qualifying broker, your compliance broker, or one of our affiliated closing attorneys for help with the special stipulation. If you are not a Maximum One agent, I appreciate you watching this video. As always, please run any contract issues or special stipulations by your own broker to get your broker's permission to use anything in a contract. Whew, this was a lot. Thank you guys so much for watching. Dana Sparks, broker of Maximum One Greater Atlanta Realtors, satisfying your needs with service, innovation, and education.